Did the man who predicted AGI by 2027 just get margin called out of existence for $16 billion? Or is this the first crack in something much bigger underneath the entire AI trade? Because a fund run by a 24-year-old was just wiped off the board in a single overnight block trade, and the losses weren't limited to chip stocks, because Bitcoin miners traded right alongside them. Leopold Aschenbrenner launched Situational Awareness LP late in 2024 with roughly $225 million. By the end of June 2026, he was up over 439%, and his fund was running somewhere between $20 billion and $45 billion, depending on which source you use. Then, on Thursday, July 30th, before the market even opened, Citadel absorbed his entire public equity book, longs, shorts, everything. The fund went from around $45 billion to roughly just $10 billion overnight. This wasn't driven by fraud or a stupid thesis or even Bitcoin falling. So in this video, I'm going to show you the exact leverage and the maths that killed him. Why AI pivoting Bitcoin miners got dragged down 25 to 40%, whilst Bitcoin itself barely moved, and where I think the real bad debt is sitting. And at the end of this video, I'll give you my honest verdict on where he was right and where he was catastrophically wrong. Do me a favor, hit the like button, make sure you subscribe to this brand new channel where we cover everything finance, AI, crypto in the future so that you can prepare yourself accordingly. And without further ado, let's get into today's video. Now guys, why on earth should we care about one young fund manager who absolutely blew up? Well, because of who he is and who backed him. Leopold Aschenbrenner entered Columbia at 15 and graduated valedictorian at 19. He worked at Sam Bankman-Fried's FTX Futures Fund, then he joined OpenAI's superalignment team, from which he was fired in April 2024 over an alleged internal leak which he still disputes. Then in June 2024, he published a 165-page essay called Situational Awareness, arguing that AGI, or Artificial General Intelligence, was coming by 2027. And here's the detail that really matters, because investors didn't treat that essay as an essay. They treated it as a prospectus. And because of that, Patrick and John Collision of Stripe backed him. Nat Friedman, Daniel Gross, and the quant firm Jane Street also backed him. 8 employees in total, 4 investment professionals, 4 people running tens of billions of dollars. Now guys, I know what you're thinking. What was actually in that portfolio? Well, the strategy was simple and quite frankly intelligent. Long the physical layer of the AGI build out, because in 2027 it's expected to arrive, right? So what does that constitute? Well, power, chips, memory, data centers, neocloud capacity, and Bitcoin miners converting into AI hosting. As of the 31st of March earlier this year, he disclosed public holdings at around $13.7 billion. Bloom Energy was the largest reported long at $879 million. CoreWeave was sat around $556 million in shares, plus another $140 million in call options. And against all of that, he was short legacy software names like Adobe as a hedge. But here's the thing, he was running at roughly 4x leverage supplied by Goldman Sachs, JP Morgan, Bank of America, and Citigroup. Let me shrink that down so it's not just a number. Imagine you put in $100 of your own money and the banks lend you $300 on top, so you're controlling $400 of stock. If that $400 worth of stocks falls by 25%, then you've lost $100. You lose your entire stake. Gone. And at 5x leverage, it literally takes just 20% to fail. And on top of all of that, you don't get to argue about the AGI timelines with your prime brokers at any point. You don't get a phone call demanding cash by the afternoon, which brings us to July. Now guys, July 2026 was brutal for exactly the stocks that Leopold owned. Nebius, SanDisk, Micron, CoreWeave, Bloom Energy, and SK Hynix all reportedly fell by more than 35% in a single month. And SK Hynix alone dropped by 14.7% on July the 28th. And the hedge, well, the short book against the software went the wrong way too. So the thing that was designed to protect him and act as a hedge, well, that also became another loss. One single session reportedly cost the fund around $600 million across infrastructure and crypto miner positions. $600 million in one day. And on July the 24th, he sent an investor letter out saying that the fund was not immune, calling the route some of the most attractive opportunities since early 2025, pointing at a possible Anthropic IPO and inviting fresh capital from August the 1st. Now, behind the scenes at the very same time, he was reportedly shopping over $10 billion of stocks to rival firms and asking lenders for emergency cash. Effectively, a confident letter out the front with a fire sale going on in the back. Now, here's the part that you should be genuinely worried about if you are holding crypto or crypto equities, because look at what he was forced to sell. IREN with over $400 million, Core Scientific 26 million shares at around $390 million, Riot Platforms $142 million, CleanSpark roughly $104 million, BitDeer, Hive, Hut 8, Apply Digital, those miners fell 25 to 40%, while Bitcoin sat between 63,000 and 64,800 the entire time. That is a genuine decoupling, and the mechanism runs in 3 steps. Step 1. Leveraged funds bought miners as high beta proxies for both Bitcoin and AI. Step 2. The chip side of the portfolio collapsed and triggered margin calls. Step 3. When the broker wants cash, you don't sell what you want to sell. You sell what's liquid and what's the most crowded. So, miners and shareholders got punished for a semiconductor drawdown that they had nothing to do with. Bitcoin never moved. Their equity did. Now guys, this is where it gets genuinely uncomfortable, because the fund didn't collapse into the open market. Overnight, Citadel, Millennium, and reportedly Jane Street ran a bidding war for the book. Citadel won and executed the whole thing as a single block before the open, reporting somewhere between 10 billion and 16 billion, with $16 billion the headline figure. Now reports suggest that Citadel paid a distressed discount, and the very next session, CoreWeave, IREN, Core Scientific, BitDeer, and Riot bounced 15 to 27%, and the forced seller disappeared. So, as per usual, retail sold into the panic, and the fast money bought up the panic at negotiated discount before anyone could see the tape. Convenient. Now, am I telling you that Citadel engineered this? No, and nothing suggests that they did. Nobody has proven anything of the sort, and absorbing that book took genuine balance sheet courage. I'm just simply telling you the mechanics, that when leverage breaks, the people with cash set the price, and the people watching a screen at home find out afterwards. And here's the detail that I can't stop thinking about. His private holdings survived completely. A roughly $5 billion stake in Anthropic, a company last valued at around $965 billion, plus MatX and FluidStack. Why did they survive? Well, simply because private positions don't get marked to market every single day. The illiquid assets lived precisely because nobody could margin call them. Now, I want to be fair here, because framing this as the start of a collapse would be lazy and quite frankly pretty misleading. Citadel absorbing the book privately is arguably the evidence that the system worked rather than evidence that it broke. And commentators including Jim Cramer and strategists like Dan Niles have framed this as a clearing event, not a crisis. But if you want to know what I think about Jim Cramer and why I believe that he is pretty much regularly wrong, make sure you check out this video where you're going to understand something about the bigger game going on across crypto, the markets, and the media. But obviously make sure you check that out after this video is finished. And if you haven't already, make sure you smash that like button, leave a comment down below because it helps get the algorithm going and gets this content out to more people who can then use it to understand more of what's going on behind the scenes across the markets. Now, what about CoreWeave? Because CoreWeave itself is not a stock story. It did nearly $2.1 billion of revenue in the first quarter of 2026, up well over 100% year on year, with a $99.4 billion backlog anchored by a $21 billion Meta deal and over $22 billion of OpenAI commitments. Broadcom's AI semiconductor revenue grew by 143% year on year to just over $10.8 billion, and Hocktan is guiding to $16 billion next quarter. And I have to acknowledge here that the numbers are genuinely conflicting, because peak assets are reported anywhere from $20 to $45 billion, and the trade itself from $10 billion to $16 billion. But notice what none of that changes: the direction of the travel on leverage. So let me give you the verdict as I promised in the very beginning, where I think it was absolutely right. First, the physical layer thesis is correct, with AI capex projected at $785 billion in 2026 and approaching $1 trillion by 2027. And second, he was right that the power and the memory were the bottlenecks, not the models. Where I think he was dead wrong, however, is this. He applied 4x leverage to the most illiquid, highest beta expression of a correct idea. 2. His hedge wasn't a hedge, it was a second bet. And 3. He confused being early with being solvent. And here's the maneuver that matters for you. It doesn't matter whether AGI arrives in 2027 or in 2037. Prime brokers settle daily. These settle in decades. So the AI thesis matters far less right now than who is financing the build out and on what terms. So what do you actually watch from here? First, CoreWeave's credit default swaps, which spiked to around 855 basis points in late July, implying roughly a 50% 5-year default probability. And to me, those numbers are quite concerning. Second, the debt share of hyperscaler capex, which Goldman Sachs say rose from around 26% in 2025 to an expected 33%, or around $250 billion in 2026. Third, off-balance sheet exposure. 5 tech giants now carry roughly $1.65 trillion in lease and off-balance sheet commitments, and BlackRock recently placed a $12.5 billion Meta data center bond at 7.53% yield. And fourth, the one that matters the most, circular financing. Nvidia is backstopping $4.88 billion for Sharon AI, backing a $10 billion cluster in Melbourne, and reportedly discussing up to a $250 billion backstop for OpenAI. Chip makers are now underwriting the customers who buy the chips, and around half of fund managers surveyed by the Bank of America now call this the top systematic credit risk in the entire market. Because the two mistakes here are symmetrical: panic selling genuine infrastructure businesses because one leverage fund died, or ignoring that the funding structure underneath them is quietly getting more fragile. Now, look, I'm not here to tell you what to do with your money, so make sure you go out there and do your own research before considering buying into stocks or selling up stocks that you own, because you can't borrow my conviction or anyone else's. So let's bring it all home. A 165-page essay treated it as a prospectus, a 439% return built on borrowed money, and a hedge that became a second loss. Bitcoin miners liquidated whilst Bitcoin never moved, and a $16 billion book sold at discount before the market even opened. So, did the man who predicted AGI just get margin called out of existence? Yes. Leverage doesn't wait for your thesis to be proven, however right he turns out to be about AI into the future. You can be completely right about what's going to happen, the market can fully agree with you, and it can still take everything from you before you end up being right. And here's the opportunity in that, because there is one. Forced selling doesn't care about the fundamentals, which means the miners, the infrastructure names that got dumped this week were priced by a margin clerk, not by a valuation. Most people saw a 30% drop and assumed something was broken in the business. If you understand the mechanism, however, you saw a seller with no choice. That gap between the two is where the informed money lives. So let me know down below, are you holding AI stocks or Bitcoin miners that pivoted to AI hosting? And did you sell into this, or have you been aggressively adding to the position? Because that's what I've been doing. Now, I read every comment, so let me know down below, because I read every comment and it really helps to understand what the sentiment of the market is, and you guys are the best people to provide that kind of sentiment awareness. Now, if you want the crypto native side of this, how miner debt and hash price actually work, then go and subscribe to my other channel, The House of Crypto, where we look into crypto, altcoins, the macro environment, and what's going to be happening from here on out. And if you haven't seen my previous videos on this channel breaking down whether the AI build-out genuinely rhymes with the 1999 dot-com bubble, then go and watch this next, or go and watch that one I talked about with Jim Cramer. Do me a favor, if you haven't already, make sure you smash that like button, leave a comment down below, and subscribe, and I'll see you very soon in another video. Bye-bye.